Hi, welcome to the Price Action Analyst YouTube channel. I wanted to do a quick video on the risks of naked options. So buying a call option or buying a put option. And I wanted to compare that to buying a debit spread. So you can buy a call option with, say, an exercise price of $2.90 and then sell a call option of $2.95. And so what you're doing is you're capping your upside, but reducing your cost to enter. So I'm just going to try to explain that. It's going to be difficult if you don't have a understanding of of options, how they work, and what debit spreads are. But hopefully I can make this worth listening to. I'm just using Costco as an example. This is a position that I'm currently in that I took yesterday or the day before. Costco's been in an uptrend for a while. We had all the COVID stuff. It kind of printed a low here, went up, retested that low, tried to go up again, and then consolidated here and pushed up again. There's two pushes here and then now a retracement. So this push up or breakout I'm expecting to eventually result in a second leg, and I'm expecting it, as it's doing, to kind of test this pink line here for various reasons. This consolidation will act as support, and you can see that it's done that. There's a low here, there's a retest of that low with a series of wicks, and again a retest of that's left a wick. And so ideally I want to get long within these wicks here, so I should have been long kind of in here. I missed this. Price is pushed up and it's doing another retracement. So this retracement here, this is kind of like a mini one of these, but because of what's happened here, I expect this to push up on the outside, on the upside. And so I entered here, and price kind of did. It opened here, pushed up, so it looked like it was breaking out, but it kind of sold down and it's retracing that trend line. So I'm hoping next week it'll move up. If it doesn't, if it keeps pushing down here, I'll have to see what happens. But so just moving into intraday. So this little heart here is where I got long. These are 15-minute bars. I got long at 10:48. So right there, and price was about, let's call it 300 exactly for simplicity's sake. It was a little less, but let's say it was 300. So I paid 5.7 for a call option here, and that was at 10:48. So price went against me there. I'm not too worried about that because my time frame for holding that is kind of a series of days. So price closed, pushed up a little bit on the close, and then the next day it gapped up, opened here, sold down into the gap, and then pushed up for a while. So that was good, but the thing I noticed here is that even though price was up, price was at 301 and change. That call option was only worth 5.15. So from here to here, I'd actually lost money in the course of a day. And the call option was 302.5. So the entire valuation of that call option is I'm not sure if it's intrinsic value. So it's all based on implied volatility, and the implied volatility is it's a subjective measure, and it's something determined by the market makers. And so another way of saying that is, if I took the theoretical value of this option and plugged it in here and it was 5.7, if I put that in a model and said, all right, what's the valuation of that out of the money option tomorrow, like a day later with a higher price, there's no way it's going to tell me that it's 5.15 where it was 5.7. So I have a belief that that's all humans. Everyone that paid more money for that the next day, the market makers are trying to stuff them with a lower price here. And so there's a couple of things that you can take away from that. If I know, if I know that price is going to open the next day and push hard, if price is just going to do that the next day, then your instrument, as far as options go, you want to just buy a call option, because it's very difficult, especially once the price goes past my strike price, and you start to have, in the money valuations. I can't remember whether that's intrinsic value or not, or intrinsic value. That's implied value, and once I'm in the money, that's intrinsic value. So, if that the call option is going to run very hard, then just buy the call option. But that's the dilemma that we have. Like, I expect Costco to eventually test this upper trend line, but I don't know exactly how it's going to do that, on what sort of strength. So given that I have a 302.5 strike price, if price just kind of meanders here and then it's in the money, but it doesn't move very hard, like, I still have a chance of losing money if it takes long enough to do it. So the other option that you have is to do a debit spread. So what that potentially looks like is, if I'd have stayed with the 302.5, I still would have bought that option for 570, and then you can sell any option, but let's say I sold the 305 option. So what that looks like is, instead of paying 5.7, I might have paid, let's say, 1.5. And then my maximum upside is capped at the difference. So the maximum value of that option would be 2.5. And to see that value, it would need to expire price at expiry. Price would need to be 305 or greater at expiry, and then that would have a maximum value of 250, which means if I paid 150, then my profit is $100. So I'm sometimes doubling my money or coming close. So what are the benefits of doing that? Well, let's talk about the downsides first. If price just rockets away, this put debit spread is going to increase in value much slower than a call option. So, that call option is going to probably, if price just, if the next day, if it had done that and just pushed up here, that call option is going to be worth many times what I paid for it down here. If it did that and I had the put debit spread, even if price moved up here with the put debit spread, it wouldn't be worth 250, because it needs to, some of that time value of the debit spread needs to expire. So the benefits of the put debit spread, though, is that even if they're manipulating the value of the call option based on the implied volatility, so 570 here and then 515 here, if I'd have bought a put debit spread, even though the prices were reduced, the difference between the prices is still the same. And so that put debit spread that next day probably would have been worth just a little bit more, or basically the same. Like, it's not, because it's the difference in the two, even if they're decreasing the implied volatility value of the options, the difference has to be the same. So that put debit spread sort of protects me from that manipulation, if you will, because it would have been the same value or a little bit higher. So to put that another way, if price pushes against me here, that the value of that call option is going to fall very quickly, whereas the value of the debit spread's not going to fall as much. If I say, all right, I'm going to get out of the debit spread when the value halves, that price can push a lot further than it can if I say that with a call option. So that, that call option's 570, it won't take very long. Price won't have to push very far against me for the value of that to halve. So a put debit spread kind of protects you against any sort of it protects you against price moving against what you think. It's going to decay a lot slower in terms of its value, and it's going to give you a chance to get out with more of your money. So the last thing I want to say is again, whereas the call value has to push up here, all I really want the price to do if I'm in a debit spread is to, it can take its time pushing up here. The whole time it's doing this, my debit spread's increasing in value slowly, and I think my debit spread expires in, say, 22 days, but all that has to happen for me to realize the maximum value is for price to be up here at expiry. So the time value kind of works in your favor with a debit spread as well. So by comparison, if I have a call option that I've paid $5.70 for, I think my break-even price is going to be 2.5 plus 570, so that brings you up to about 307, 308. So with the naked call option, I need price to be up here at expiry just to break even. So in this example, if I have a put debit spread, I just need price to be up here to realize my maximum profit. So if you're not familiar with options, you're not familiar with debit spreads, this is a bit difficult to take in. But I guess the conclusion of all of this is, if you buy a call option, for it to work out in your favor, price must go in your direction almost immediately, and it must run very hard in your direction right away. You can see here, even if price goes a little bit in your direction, you can still lose money. And in fact, I've been in positions before where price has gapped significantly higher, and the option's been worth less. So just bear that in mind with the option. So, debit spreads give you a lot more leeway in terms of what price has to do to make money. Like, sure, if price rockets up, I'm still gaining. And if price takes its time, that's fine, I'm still gaining. By expiry, price just has to sort of expire above the top line. So, yeah, unless if you're buying options, buying a call option or a put, you have to have a reason as to why price is going to move very quickly in your favor. And so for me, I want to buy lows like this. And so the only way for me to kind of time lows like that is when price moves back down into those lows. Like if I had bought that option here, it'd be very, with that sort of move, or on this wiki here, if I'd have bought an option here, with that move up to here, it's very hard for me not to be making money. It's still possible from what I've seen, but it's very unlikely. But to time a move like that, you have to be getting long in a position like that. A lot of people like to trade breakouts, and I generally don't like doing that, because let's say I'm trading the breakout of this line here, if my option goes up, but if I'm expecting it to push up here and I'm holding it the next day here, like I've lost a lot of money if price doesn't immediately go my way. And so when price breaks out, it tends to do that more often than it'll just push up. Again, here's another example. Like if you're trading the breakout of anywhere around here, or the break above this bar, price pushes up and then just rolls back. And so I like to try and pick these, in an uptrend, I'll try and pick the lows, the retrace lows that are indicated by wicks and Bollinger Bands. So, that is, to me, is the ideal place to buy a call option naked, where, that's the only way I know of sort of timing where price is going to run hard in your favor very quickly. This one wasn't as good because it's gapped up, but then it's retesting the gap. But I'm I bought here as opposed to here, and so if price next week can push up to here, then I have a chance of making money. Otherwise, if it rolls back, I'll probably look to get out of that option. But yeah, if I had the debit spread instead of a call option, price can roll back here, and the value of my position is decaying a lot slower, and as if price can push back into here eventually, then I'm maximizing my profit. Whereas with the call option, a 302.50 call option, if price goes back here, for me to make money, it's got to come all the way up to about 307, 308. Just for me to break even. So it's a lot harder trade. So again, the only reason to buy a naked call option, you have to have an expectation that price is going to push very hard in your favor immediately. Otherwise, to me, a debit spread's a lot safer mechanism. And also, as I've shown here, if price doesn't push very hard in your favor, then your position is also subject to the manipulation of the market makers. There's no way theoretically that with that price action that it was 570 the day before, and then the next day with an increased price it's 515. You're just getting screwed by market makers. So that's another reason why price has to push very hard. And with that debit spread, you're not vulnerable to that manipulation like you are with a naked call option. So that was a long video. Hopefully that's helpful. I just wanted to point out the risks of options that you don't hear people talk about very much. Please like the video and subscribe if you want to hear more. If you have any recommendations for stock or cryptocurrency analysis, please let me know in the comments. Thank you.